Mark Mathew joins us now. Let's connect with him. Let's talk markets and let's talk about what he makes of the current market setup. Mark, fantastic to have you back. Thank you for joining us. Mark, for a market which was struggling 2 weeks ago, whether it was China, whether it was Middle East crisis, US macro data, global markets have rediscovered their rhythm. Can we say the storm has come and gone?
Can we say the storm has come and gone? No, of course not. There are always storms on the horizon, but as investors, we know that that we shouldn't fear them. They come and they go, and so I guess what I'm trying to say is that there will be more storms, but we should remain invested.
But are you somewhere surprised the strength of global markets and especially the US markets? Dow made a new high last night. Nvidia has made a new high. While we can make a case for US economy slowing down, but that in a sense is not the deterrent, at least for equity investors.
I am surprised. We had been expecting more volatility and more downside to the major US indices going into the presidential election. And I guess what's happened is the economic data has been very good in America, as evinced by the strong retail sales and weak unemployment claims yesterday, but there are several other data points that would confirm the strength of the economy. On the other hand, inflation is tame, as we saw in the most recent consumer price index readings. And then the third quarter results, the banks are the first major sector to report, and they did well. And then Taiwan Semiconductor yesterday announced a 54% year-on-year increase in their earnings. So we could extrapolate from that the artificial intelligence story is for real. It's not just a story. There's real money behind it. So there are all those things going on, but I guess I'd say also that the polls are indicating quite clearly now that Donald Trump will be the next president. And as chaotic as his first administration was, I don't really see why the second one should be any different. It was good for the stock market. We all know that. The stock market under Donald Trump did very well up until the pandemic. And so that's probably the reason as well why the market's been so robust.
Is that a fear that who is going to be the who's going to be the next US president, something which could add to volatility? Because the Democrats have already got on record and have said the following, that if they come back to power, they would be increasing corporate taxes, and corporate taxes go higher, earnings they go lower.
Well, that would require what they call a blue wave, the Democrats securing Congress, which is very unlikely. The chance of that is in the single digits. So they can talk about this populist agenda, which they should. I mean, it's in their DNA. They're supposed to be the party of the working people. But the reality is they won't be able to do those things. I think the concern about the election was more that it could be extremely close, and you could have unrest as the results are argued over. But as the polls are now showing Trump with in excess of a 20% lead, the likelihood of that kind of uncertainty around the election is diminishing.
Mark, what are your thoughts on this India versus China trade or China versus India trade?
Well, the way I put it is that over the next 6 to 12 months, China will outperform India, but over the next 6 to 10 years, India will outperform China. So it depends on your time horizon. But right now, I think that China has some very interesting things going on. We all know the 180% degree change in policy. I don't mind the fact that the market has cooled off a little bit, shouldn't go up 30% in 1 week. And I think the authorities also don't want that. But clearly, there's been a major change in their policy. They now do want to stimulate their economy and get their stock market up. And well, not 30% in 1 week, but on a sustainable basis. And it's still extremely cheap. I could give you 40 names in China, large liquid stocks, where numerically the price earnings ratio is below the dividend yield. And I remember Peter Lynch, who was a star Fidelity fund manager in the 80s, value investor, used to say, if you can ever find a company where numerically the price earnings ratio is lower than the dividend yield, that's an extremely cheap stock. So I'm not going to give you all 40, but just for example, HSBC, which you probably know, has a price earnings ratio of 6.4 times and a dividend yield of 7.2%.
The disconcerting factor, Mark, we were discussing is when it comes to the quarterly earnings back home. Is there some sort of a sense of a slowdown that could be prolonged due to macro concerns in India?
I don't know if it's macro concerns, but you're absolutely right. I think the major issue facing India now is the deceleration in earnings growth. And the Nifty will still clock around 10% earnings growth this year, but the most recent quarter, it's looking very flattish. And yeah, I don't think this is really driven by the economy, but I mean the economy looks fine to me, but you do need earnings growth to keep the Indian stock market going. Like a stock market anywhere in the world. I mean, in the absence of that, it looks very expensive.
Mark, so if you have to, let's say, choose between US stocks, global bonds, gold or Bitcoin, which way would you lean for next 12 months?
I guess I would lean toward global stocks because I do think that the Chinese market will be heading higher over the next 12 months. And there are still good stories in other major economies of the world. The emerging markets do have quite strong GDP growth in front of them for the next few years. The highest relative to the US in 20 years, I might add. And global stocks, of course, includes the US. So if I'm wrong that the rest of the world doesn't outperform the US, well, you've still got the US going for you. But I think things are fine. The US economy looks good. The Chinese are stimulating. The election is probably going to turn out the way the market wants it to. Geopolitical events do not seem to be causing any impact on the world economy. In fact, potential for some deceleration in geopolitical problems over the next 12 months. I think it's pretty, that could happen. So yeah, global stocks would be my long-winded answer, I'm sorry, to your question.
Okay, fair enough. But Mark, let's also understand what the outlook is when it comes to some of the exporters, owing to where the rupee is headed, and I'm sure a lot of the other emerging market currencies with the movement that we've seen on the US dollar. How do you believe some of these companies or sectors are likely to pan out?
Well, if it's purely based on the dollar, I think that the dollar is probably should weaken over the next 12 months, but it's very difficult to call because other central banks will be busy cutting interest rates as well. The ECB just cut 50 basis points last night, for example, and Lagarde had a very dovish press conference. Anyway, I hesitate to make a strong directional bet on the dollar, but my bias would be, if I had to make a bet, a bit more softness, which I guess would be therefore negative for the exporters.
In terms of an asset class, Mark, right now, what is your classification? Because, it's a strange time when you've got both precious metals at an all-time high, and so are equities and crude as well. It's pretty unsettled, and one would say at elevated levels.
Yes, the world is changing in very weird and wonderful ways. So I think that what you're seeing with precious metals is tremendous appetite from a wide variety of investors in that asset class for a wide variety of reasons. But probably most of them relate to geopolitics. And and the idea that there's been such a bifurcation in wealth between the rich and the poor, sort of around the world generally, that increasingly governments will look to tax the rich more, and gold is a non-system asset, so it's less easy to be taxed. But anyway, I'm sorry. I think that generally speaking, things look fine. I mean, certain markets that have done very well, like India and like the US, are expensive. And so perhaps next year we'll see rotation into some of the cheaper markets like China. I don't know where else, maybe Japan, I don't know. But generally speaking, I think the outlook in the world is fine, and we shouldn't be pessimistic.
Look to up the allocation to gold vis-a-vis equity right now?
Oh, we're much more overweight equities. I mean, if memory serves me right, we're about, we're over 50% in equities, and we only have a little less than 10% in gold.
Okay, great to have you then on the show. Thank you so much, Mark, for speaking with us today.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits, and then break right through them. Become something more. It's my time to rise.